Here. Hello, friends. Welcome to TA Q&A. It's August 9th. We're just in the middle of discussion, just starting it up with Lamont here, who's talking about crypto ranges and how he's using range trading. And was it point of control or value areas you're talking about?
Yes.
Yes. Okay, both of those. And he's just going to talk us through the process a little bit. So yeah, here we are. Go ahead, Lamont.
Sure. I mean, I wasn't planning on it, but happy to. I think Rick also has some questions about slightly relevant subject material, although he was trading BA. So basically, if you don't know, if you don't know me, I'm Lamont, and and throughout the last year, I would say, I would say that in the last 2 years, I got into a pretty good flow. I see Mav is here, so she knows personally. But in the last year or so, I've had to make a lot of pivots because of adjustments to account sizes, essentially. My own accounts have been growing, of course, but then also I had to take on an account that is honestly still weighing on me. My Korean Moms account, it's much larger than any of my individual accounts. So essentially doubled up, a little bit more. I doubled up the size of my operations, and now I've made it to 5 total accounts. So that I have 2 IRAs that I manage, my wife's and my own, 2 essentially shorter term accounts, although my wife's at this point is practically an extension of an IRA. So 2 quote unquote swing trade or day trade accounts. And then I have this one, a large account, Korean Mom's account, which I'm really focused on, essentially like the IRA, but an aggressive IRA, because in my IRA and my wife's IRA, really what I'm doing is I'm just accumulating dividend stocks, buying weakness, selling strength. However, in Korean Mom's account, she gave it to me at a really, really bad time. She was in many assets that were just too extended to the upside, and she bought many tops. And so during the correction, her account, suffered a very large drawdown. And so I've been managing that. And what I've settled into, so because I've had to make all these adjustments on my operations, I had to move away from my bread and butter trades, which are essentially like 1 to 5 day swing trades, which you'll see me post very often about in swing trade. Although the last 2 weeks, I feel like low hasn't been terribly high in volume, although I've been focused on futures, that might be why. Anyway, so I had to change my approach, right? Whereas before, when I was doing the 1 to 5 intraday, 1 to 5 intermediate swing trade approach on like 1 to 4 accounts, really it was just like 1 or 2 accounts, it was no problem. I would scout like a handful of trades every week, and then I would execute those trades, no problem. But now with this new account, I cannot scale up in the same fashion. First of all, I'd have to find way more setups, right? More often I'd have to find these setups, and it's way more management. I have to essentially manage the same exact trade across different assets, across different accounts. And it's too much bandwidth. You hear me talk about bandwidth all the time. You always want to operate, in my opinion, in general, right? You typically want to operate below your bandwidth, just like in your regular life, right? You don't want to be constantly worried that you have to do all these million things or whatever. And so trading is no different. It's a business, right? Your business operations should be lean, right? So that you can run them as effectively as possible. And so that if your bandwidth is taken away by life events or whatever, things that demand your attention, then it's not that big of a deal. Right. So I had to start implementing these lower bandwidth style trades while managing many different timeframes and many different positions. Right. I think there's like 50 positions open across all the different accounts. There is some overlap, which I am trying to, manage. Right. We have like some shares of this asset here, some shares of this asset here. Whatever, it's balanced. Anyway, so the tactic that I use, this has nothing to do with strategy, right? This is not really, at least nothing to do with like, your long-term strategy. How am I going to, actualize whatever goal it is that I'm trying to do with my trading? This has more to do with executing a tactic once you understand what your overall strategy is. So my overall strategy then is to build these accounts with very, very little management. And of course, I want to carry very minimal risk. Obviously I always want to carry minimal risk. And so the tactic that I've been employing is essentially range bound trading, right? I've been taking responsive trade within a range. Okay. And you're probably, well, I guess let me cover that, and then I'll get into how we can use responsive trade, range bound trading to catch trends as well, right? Because I'll get into that. So really quickly, range bound trading is really just taking, once you have a balance area, right? A balance area is when price is just chopping around. It's not trending, right? So let me share my screen. So if you've been here before, you've probably already seen this Bitcoin example. I've used it many times already. However, these two recent structures, it provided opportunity. I can show you how you can use this on different time frames to capture these trending moves as well. Okay, so essentially all you really need to know about balance is when, again, we're going sideways, right? So even this is technically an area of balance. Right. And then of course, down here is an area of balance, right? Let me just drag one of these down, I guess. Okay. Right. So I can kill all this. We'll set them up again, whatever. Right. And so we're range bound. We know we're range bound because, well, obviously price is remaining above $28,000 and it's remaining below 40.5, whatever the case may be, right? And so this range bound, these range plays, in my opinion, were fairly easy. I don't know if I posted about this initial one, although I did text our group chat, Marilyn, Mev, about it when we were down here. So that was the first attempt at this range bound play. And at this attempt, I was actually making an assumption that we would stay within range. You'll see this happen very often. Very, very often, where you'll have an established range, will break above that range, trade above it for a while, then come back below and retest that range. The first time that I noticed this was Tesla. Tesla, one of my best trades ever, right? It's one of my oldest, really when I was first starting to really put it all together, in my opinion. So if you look at Tesla from way back when, that's exactly what happened over here. Right? This is exactly what happened over here, where we have this big old trading range, huge trading range that price stayed within for over a year, right? 2 years, almost 3 years. And then we came up to have this upper range, right? And then we came back down below. And what do? All we do is we come back down and we test the low ends of this prior range, and then we rip back up. Okay, so this is simply how price works. NEE is another good example of that, but it's far choppier, right? NEE on the daily time frame, right? You have this, excuse all the scrolling. You have this range, right? Just gonna do it real sloppy. Then you have this range, right? Then you have this range, okay? And then when you collapse back down, where do you find preliminary support? At the lows of this range. Then we go to the other side, we come back into this prior range. Where do you find more support? Look at that, near the lows of this range, right? So think about it, right? It's no different than like an army, right? Advancing, right? You have to secure location before you can advance. If you are pushed back, you'll have to fall back to where you have previously secured a position, right? So this is essentially, it's the same idea, except instead of, I don't know, instead of like allies versus the axis, right? You have bulls versus the bears, right? It's the same idea, right? Okay, so yeah, so that's it in a nutshell, right? When you are taking responsive trade, you're taking trade from one side to the other. RTY is a very good example of this recently, right? I took short trades down here, I took long trades down here. I'm still in one long trade, one for RTY. INTC is the same. If you've been in these calls, you've heard me talk about all of these trades. Same exact idea, right? You have this big sideways range. We come down and test the lows, we go and test the highs, we test the lows, test the highs. This is simply how the market operates. So over here, we break up above this prior range, we are unable to hold it. What happens? We go test the low end. Same thing happens here. What happens? We go test the low end. Okay, and if we can't violate this low end, or if we violate this low end and do not attract a lot of volume, just like we violated the high end here and did not attract a ton of volume, you can see over here, you have this initial volume spike and then just declining volume, and then big volume sends us right back in. So we have to find a lot of acceptance above the prior range, put in a bunch of volume if we're ever going to attempt to hold these new ranges and stay constructive, right? There are only so many things that can happen when you retest the prior range. Okay, and this is not an issue of guessing. We're not trying to predict what's going to happen. When you enter a prior range, what you anticipate to happen, because the prior area of balance is now in question, you anticipate more balance again. And if you're going to assume more balance, then of course you re-enter balance, you go look to the other side to see how balanced are we, right? How strong are these sellers, right? Where do we find more buyers? Can sellers take it down to the other side? If sellers are unable to take it down to the other side, that is a really good clue, right? So if we stop right here near the highs, that shows, okay, short-term bulls, very strong. They're not allowing price to re-enter. If we come back in and we just cut through the POC, right? We get no stop whatsoever, sellers are strong. If we don't come near the POC and we turn above the POC, sellers are weak, buyers are strong, right? Because if you expect balance to occur, which is what you should expect, and then it cannot occur, this is very telling. Just like if you leave a range and you don't get much follow through, again, this is very telling. Work is a really good example of that. Right? Work where you, oops. Why is BMV? What the heck is BMV? Did they change their ticker? What on earth? Huh. Something must have happened with Slack. Either way, the range that I'm discussing is essentially this big sideways range. I don't know if it's exactly the same anymore. What the heck happened to Slack? Either way, it breaks down below the range. It doesn't attract much volume. And then so we resume, we come back into the range, and then we just go right to the other side. This is just what you expect to happen. Okay. So responsive trade side to side. And remember, markets are more often than not, it's like between 60 and 70%. Markets are balancing. They're range bound. They're not trending. Okay. So now let's go back to discussing potentially how we can use this concept. Right. So I imagine this is a very straightforward concept, side to side, just get side to side. It's like ping pong. All right. And so now what you might be interested in, I don't know. Let's say, hey, Lamont, listen, I don't like making plays off of these longer time frame balance areas for whatever reason. So I'm more of a trend trader, but I like to wait for some confirmation. I don't want to be an innovator. I don't want to be the people who are getting in before the move and start the move. I want to be an early lagger, right? Or a late innovator, right? Somebody who waits for a little bit of action first and then jumps onto that momentum. Totally fine. Whatever trader you are, that's totally fine. And yeah, so then we can look at these areas, right, of these higher lows and look for different ways in which we can employ our tactic, right, to catch this trend. Our tactic, our trading tactic, our actual trade itself is going to be a balance area trade, okay? And now, obviously, if we're looking at this daily chart, there's not much balance, right? But I disagree. So the first thing that you want to look out for balance on a time frame lower, right, is overlap on candles, right? So for example, if you look at SPY, right, if you look at SPY on the COVID low, right, the SPY COVID low, I know, is a very good example of this. Oh, must have been speaking about it recently. This all, oh, that was from, I remember. Okay. All right. So look at these moves over here, right? These candles have very little overlap. Sure, there's a little bit of overlap here. Okay. All right. But very little overlap, right? Most of these candles are just ripping down, right? Especially on this leg, right? A little bit of overlap. Whenever you have overlap on one time frame, the time frame below, no, it's got to be either one key time frame below or more is imbalance, right? Because think about it, if the daily chart is a bunch of inside bars, then the hourly chart, of course, must be chopping around, right? That's just how it is. Okay, so when you see overlap as such, then you know, okay, it's time to be looking for some potential balance. So using Bitcoin as our example again, and highlighting this higher low, right? We wanted to capture this higher low. So we want to ask ourselves, all right, well, how could we have used our balance trade? Because that is, in my opinion, one of the lowest management trades that it's so, I hesitate to say easy, right? Trading is typically challenging regardless of how intuitive it may feel or whatever. But this, in my opinion, is very intuitive, straightforward trade. It should be fairly easy to execute relative to other trades. And you can control your risk very easily, and you can create contingency plans very easily. So after I get it and done with this, I can touch upon contingency plans, unless Rick, you have that question that you wanted to ask. So in this, if we zoom in, I should say, into the hourly time frame, and we look at this lows, and then we just very casually look to the left, I'm sure what you'll see is that there was already choppiness here, right? So we already had a range established here, right? As such. Okay. And so this is really no different than that Tesla example. It is no different than that Bitcoin example, right? We have this range already established over here, moved above, came back into that range, right? It's no different, right? We have this range, established, we move above. It's honestly very similar, honestly. And then we have this little structure here, fails. We come back, what do? We come test the low end of balance. Now, we don't actually get to the complete other side of balance, which is fine, right? The way that I like to set up, as you've probably noticed in the larger term time frame trades, a bunch of these trades, they did not get 3 fills. This one didn't get 3 fills. This one only got 1. The reason why is because I like to set up my zones of interest as such, right? I put my middle fill where I think the turn is most likely to occur, all right? Most likely to occur. So usually pretty close to the close. And this is where the auction starts tapering. The contracts start becoming very low. The volume gets low. So I want to fill as close as possible to the taper, but I also want to include a fill that's below all these lows. Why? Because I know that very often, particularly in crypto, you'll get a low violated and then the move resumes. Like here, low violated, resumes, right? Like over here, these lows are violated, resumes. Like over here, this low is violated and resumes. So for me personally, I prefer a higher hit rate. I want to have a piece of this trade if it's going to be a winner. I don't really care how much it can make me. I cannot control for reward. I can only control for risk. And so this is me controlling for risk as best as I can, because if I have to stop out, if I'm forced to stop out, I'm assuming max risk on that attempt. It doesn't have to be max risk on the trade. Maybe I only use some of my risk capital to take this attempt. And then if I'm stopped out, I have some more that I'm ready to allocate. That's fine, whatever. So in this situation then, looking at this sideways range that was established on Bitcoin, right? I would probably like to have a fill. Remember, my middle fill should be somewhere over here, right? So I'll probably be interested in bottom fishing these lows, right? Because especially because if we didn't make this play here and then it bounced, I would definitely be bottom fishing these lows, right? So let's assume that that's the case. Let's say we weren't aggressive here, although we very much could have been. If we were aggressive here, personally, I probably would have done something like this. Right? I want that middle fill to be near the taper area. I want that top fill to be near one of the most recent low, right? That ripped. Okay, so this low ripped a higher high, so I'm interested in that. If you were to retest that support, that's interesting. However, if this higher low only led to a lower high, like over here, and then reject it, obviously I don't care about that as much, right? So because this last higher low was a last higher low before a big move up, and it did continue to even more upside, when we come back and revisit that support means a lot more to me, okay? Supports that lead to higher highs, horizontal supports, much better, all right? So there are levels to support, right? Of course, diagonal levels, not as significant as a horizontal level, simply based on the fact you can draw it from wicks, you can draw it from bodies, that'll change the slope incredibly, right? And so it'll have more divergence the further out it goes. Additionally, you can chart on log or linear. So these horizontal lines, if it's on linear, it's a diagonal line, I mean. If it's on log, then all of a sudden it's really a parabola on the linear scale. If you have a straight log line, it's a parabolic on the linear scale, right? So yeah, so this is how you could have set up a range-bound trade, right? It's a range-bound tactic, right? To try to catch a daily higher low on Bitcoin. Right. And of course, the range bound trading within these ranges is also fine. But for me personally, I keep it simple. I know what time frame I'm trading. For me, I'm swing trading crypto. I want to build a position. I know I'm looking for a monthly higher low. I want to build a position on the weekly or the daily time frame. Obviously, the daily time frame provided me with a lot of structure to do so. And if you're more of a day or interweek kind of trader, you swing for 1 to 5 days, whatever, then this is probably going to be something you'll be doing regularly, where you're looking for the hourly ranges. When the daily trend is strong, you're looking for those hourly ranges to try to bottom fish the low ends of the range, knowing that if the trend above, in this case, the daily time frame, if it resumes to the upside, then you'll be along for the ride. Okay. Now this occurred here as well. All right, we have this balance area here as well. And so theoretically, if you wanted to run this play here, could have had the same play as well. Same exact play, right? Where again, we're looking for continuation as we're looking for that monthly higher low. We know the daily trend just changed. So that's just what we're looking for. We're looking to potentially find a monthly lower high. So we're going to trade with the bulls until we start to think, okay, it's probably about time to anticipate the potential of a monthly lower high. Not necessarily it needs to set one, but the potential is there. We're going to start coming out of this trade. Okay, so this is the same exact setup, right? We want to have that middle fill here, right? And then we want to include a fill below the lows, right? So again, maybe we just get one fill, no problem. But think about this, putting it all together, right? If you put it all together, right, and you grind out a position. Now, these aren't really great examples. And here you could have got 2, shots at this. And here, back here, you probably could have had 2 shots at this. But really, the daily example is a much better example because it gives you so many opportunities. Think about it like this, right? Each time you position one of these trades, if you take 40% profit and then 40% profit, like you chop it up in the middle, you chop it up on the other side, you're holding on to a 20% runner. Okay. You're holding on to each time you do that, right? So by the time this structure resolves itself, you should have, 30, 40% of a full size swing that is carrying no risk because every time you've positioned, you've already taken profits and protected each piece that you've added. So you do this responsive trade again, in accordance with the macro trend. So if your responsive trade is long, the macro trend above should be bullish because you're trying to catch the trend with it. You run this thing over and over again, you build out a position in the range. And then if your thesis is correct about that macro play, you're sitting pretty. You've carried really next to no risk. After your initial attempt, your risk is so low. After every follow-up attempt, your risk is even lower because you've already banked the gains, right? You've already protected the swing positions that you're going to ideally swing. And then if it were to resolve to the downside, no problem. You just rinse and repeat. You run the same exact thing on once we start bottoming out, once we start finding some balance. And now the final thing, I know I'm just monologuing on you. By all means, stop me if you have a question. But the final thing is a contingency plan, right? Contingency plan. This is, in my opinion, once you are incorporating contingency plans into your trades, that's a big level up, in my opinion, right? You start to miss far fewer trades. So the trade that in the past used to be a full stop, max risk full stop, now it becomes a situation where you can potentially still turn that essentially an incorrect play into one that can be profitable, right? It's also correct, right? As long as you're controlling your risk, it's a fine trade. Anyway, so the contingency plan for responsive trade is if it's called a look above and fail or a look below and fail. If you pop above and then you just get nothing going and then you return into the range, right? Then you can come right back into that trade and then target the opposing side, which I think has happened on like RTY. It happens all the time. But let's see. Out of all of those examples, RTY is a pretty good one, right? From back here. So we already have this sideways range established. We rip to the upside. We don't see a follow through. We come back into the highs of this range, right? So pretty much around here. And then what do? We just go run and test the other side, right? So essentially what you can do is you can set up some of your risk capital, right? To scale in as such, like that. Maybe you're looking to top fish these highs. You scale in, right? Okay, great. But you only use half your risk capital. And so if you're stopped out here, you still have half of your risk capital ready to go. And so if this occurs, the failure to stay above re-enters the range, you can come back in here as well, stop, sell in, throw your stop above this day, right? Because you don't assume that this day will be violated. You can use the high as well, but in all honesty, I think the day is probably good enough because if something's probably wrong with that trade. And then so this is your contingency plan. So you have a follow-up plan that theoretically, if your RR in the original trade is good, 3-to-1 or so, then using half of your risk capital is and then losing it, and then using the rest of your risk capital should be enough to recoup the losses on that initial trade. Additionally, you might actually have less risk, right? You have less trade risk, percentage risk, distance of your next trade to your stop, which then if that is the case, so like let's say you were scaling in on this trade with some of your risk capital like such, right? And then your long and short boxes like this, then maybe you're risking because you want to have it above the highs, right? And you want to include a fill above the high as well. So you want to give it a little bit of wiggle room. This is 3% risk, 69 points, compared to 1.97% risk, 45 points, right? So you can be of a bigger size on your contingency plan very often, right? So, this is another way, essentially it's another way of managing your risk, right? Managing risk doesn't have to be one way. There are a million ways to manage your risk, right? You can just come in full size, have a hard stop, fine, no problem. Or you can chop up your risk capital, or you can buy different instruments, right, to hedge against a position. There are a million ways you can manage your risk. And so when we say, you have to have a stop for every trade, it's really more so a thing in the beginning, right? We want to make sure you're practicing these good habits, and then you can start exploring with different methods of risk management. Okay. So I think that covers everything. Oh, one more thing, I guess, identifying balance, right? What are some early indicators that we're going to be in balance? What if we don't want to wait? First of all, it's totally fine to wait. Like I didn't trade this RTY range until over here. So it is totally fine to wait for an established range, no problem. But if you want to try to be early on this, if you want to try to be aggressive on this, then actually the Bitcoin example is very good again for that. So let's see, we can use this range, right? So for example, what are we looking out for here? We're looking out for some key things. All right. So first of all, you have this initial preliminary support established, right? That's great. And then we have this higher high, right? And we don't see a lot of follow through, right? This is certainly not trending like it was over here. It's not seeing a big move, right? So we're paying attention now, okay? We're going to pay attention. If we start seeing these higher highs with less follow through, we know momentum is slowing. We're probably going to come into a little bit of balance, right? We're over here, we're not really balancing on the daily time frame. We're just trending up. All right, but now that we're starting to stall a bit, right? So for example, here, you don't see any higher highs with no follow through. You just see an EQ continuation. Now, once we start seeing higher highs with minimal follow through, this lets us know, okay, pay attention, all right? Pay attention. Now, once we get another higher high with no follow through, we're paying attention. This is very much not this. This is very much not strong trending, right? So we're starting to notice a tone shift, right? A shift in the dynamics of the market. And then we come out and we take out this low. This is probably the most key thing. At this point here, we know, what did bears try to do? Bears tried to send it below this balance area. How well did they do that? They did not do it well. What happened after? Bulls returned it back to the highs of the range. Did we get a lot of follow through? No. Are we still very much likely in balance then? Yes. If we retest these lows, is that a trade if we're still looking long? Absolutely. Absolutely it is. You see what I'm saying? So the initial indication of the balance is going to be this tone shift from very strong trending price action to price action that all of a sudden is not trending so strong, right? As soon as it starts not trending so strongly, you know tone has shifted. Additionally, once this support gets violated with no follow through, what does that mean? What does that mean? If we can't find follow through on the high end, obviously, bulls don't have enough juice to continue, right? If we can't find enough follow through on the low end, obviously, bears don't have enough juice to continue. If bulls and bears don't have enough juice to continue, what's happening? Balance. And so now that I have established that this balance area is there, I can be very confident in it. I can now trade with it, right? I can take these balance area trades. And of course, you may be wondering, okay, well, what if I want to catch 15-minute moves or hourly moves? It's the same. These are all balanced. This is all balanced. These are all little tiny balance areas. You can take these concepts, scale them down, scale them up. And again, I love this kind of trade because you can apply it to so many different settings. You can use it to catch trends as well. It's not just responsive trade. There are a lot of people out there who say, oh, well, some people, if you trade responsive trade, you only trade responsive markets, whatever, then, and you'll never catch a trend. No, right? It's always about how you do it. It's never about what you do. It's always about how you do it. Right. So I think that covers everything. Sorry to monologue on you there. Let's see here. Please continue, Lamont. Last specific cue on Wednesday after reading more about POC on my own. I cannot control reward. I can control risk. I like this. That is a straight up Daltonism, Rick, and it's, something that we all understand. We all know this. You have no idea. You can't control for reward. The market dictates how much reward you get, right? But you can't control your risk, right? And the lower that you keep your risk, the less outflows you have, the less recovery you'll ever have to endure, right? If you take a 50% haircut, you got to recover 100% just to get to where you were at, right? So controlling the outflows, it's so important, I feel like I can honestly say this pretty I can honestly say that in my experience, traders who are doing well think in terms of how much money can I lose as opposed to how much money can I make. Right? You don't want to think about, I want to make the most money as possible. You want to think about, I want to be in the market as safely as possible. If you're in the market safely, somebody else is inherently in danger. Right? If you're in the market safely, someone else who took the other side of your trade is inherently in danger. And so really, you just don't want to be in danger. You don't necessarily want to be winning. You just don't want to be in danger. Okay. Let's see. Do you use overlapping POCs or POCs that are getting closer together to know if the bulls? Absolutely. Yes, that's such a good point, Eric. Yes, absolutely. So the way that value and POCs migrate tell you a ton about the underlying strength of the market. We can use ES as an example. hold on, let me just change these alert settings here. The trade lines. Okay, so you can see this, for example, on the ES. Right. Okay, so for example, on this last leg up, right? This is the value area, by the way. This like a kind of shaded box. This is the volume value area where 70% of the volume is traded. The POC regarding time is this green line. This is where price spent the most time. Regarding volume, it's this pink line. So can see that value over, especially over here, it's overlapping here. But then on this day, it's moving up. And on this day, it's moved up as well, which would suggest that we're finding more acceptance bullish, right? We're finding bullish acceptance as price ups, we're attracting more volume, right? So now, although despite that day on Friday not being a powerful breakout, this is not the kind of day a bull wants to see after all of this bounce. This is honestly a bit of a red flag. But at the same time, value moved higher, the POC moved higher. You really can't complain that much. And now you take into consideration this day, what's going on today. Okay, so value, we just barely made it above the balance area. We did not get a lot of momentum. And so this is potentially a look up and fail situation. If we come back into this range, we anticipate retesting the low end of this range. We know all these things to be true. These are the reasonable expectations. So now we look at today. Where is value today? Value is overlapping. That is not very convincing, right? If bears are going to mean business, then they're going to be selling, they're going to drive value lower. We're going to re-enter this balance area. So ask yourself, what is the market doing? How well is it doing it? As of right now, it's trying to prevent upside. We're trying to really just balance. And bears are trying to come back into this balance area following the fact that this bull break didn't see much follow through. The bears are not doing a very good job of that, right? Because what did we do? We came back down, and what did we test, Rick? Which I know you saw the power of this now on BA today. What did we test? We tested the POC, okay? The point of control. This was the fairest place to do business on this day. So if we're going to remain constructive, think about fortifications, right? Where was there a bullish fortification? It was here, this POC that was captured, right? It was literally taken as support, and it acted as support today, right? And so if this continues to be the case, what must happen? Value is going to develop higher than here at least. So while we have overlapping value compared to yesterday, at least the bulls are still defending, not allowing us to come back into this range for now. Obviously, I have no idea how this plays out, but this is essentially how you want to perceive, in my opinion, the market in general, right? You don't want to just trade price. Right. I know what, I know the axioms, right? Or rather, I know the phrases, right? Price is king. I agree with that, right? But if price is king, then time and volume are his advisors. Well, rather, time is just time. Time regulates everything. But volume would be maybe, I guess, his support. Volume would be the support that he has from the people. And as we know, right, a king without the support of its people for long enough, eventually will lose his head, right? Eventually, one way or another, one way or another, without mass support, right? It may take some time, it may take a lot of time, but that's typically what happens. So yes, overlapping POCs are important. They're prominent POCs, right? If there's a bunch of POCs there, and this is again adultinism, if there's a lot of POCs lined up somewhere, then the odds of us finding more resistance or support there are of course higher. Why? Because that just shows that the fairest price to do value was longer, right? If we have two POCs there, that means on two separate days, that was the fairest price to do value. Therefore, if we revisit those sites, it will be contentious, right? Because people don't forget. It's no different than value of an item, right? Think of it as buying an asset. Like think about SPY as a car, right? If you have bought the car, if 10,000 of your friends have bought that car for $1,000, right? And then it marks up to $15,000. Do you want to buy that? No, right? Because you understand value, right? Now, let's say that price comes down to below the price that everybody paid for, right? Are you interested now? You are interested now because you understand value, right? So this is essentially how you kind of want to look at POCs and value. You want to make sure that POCs in an uptrend, a strong trend, POC should be migrating up. They should keep going up. Why? because if more and more volume is traded to the upside, that means more acceptance is being found in higher prices. That means the POC is migrating. And the reverse can be true. If the POC is migrating down, price is going down as well, and it's below the POC, and we're finding more volume there, what's probably going to happen? The POC is going to get dragged down. So you want to trade price, but you also want to trade a value. Where is value? And that's why if we re-enter this range, I for sure will be interested in targeting. I don't know how I'm going to do it yet. Unfortunately, I have all my contracts kind of tied up. But I will be looking for a trade to the other side. If we come back into this daily range, I will certainly look for a trade to the other side. And if we don't get to the other side, okay, no problem. That lets me know bulls are stronger than the balance area, than prior in the balance area. So I'll likely, well, first of all, I'll probably take profit anyway. At the POC, I pretty much will always take profit. That's what happened on RTY. And then you protect that position, hold it for the other side. If you can't get to the other side, you're stopped out the piece that you held. What do you now know? You now know there's some underlying strength, and you can flip directions and start looking for trades the other way, right? So it's like, you know, it's like a, essentially like a, it's like a process of elimination almost, kind of. Okay, so I hope that answers your question, Eric. Can you upload this recording from today? Yes, we will, for sure. I believe we have it record. Yes, it is blinking. How did you get market profiles in TOS? This is called monkey bars. So just go to chart mode, go to monkey bars. And if you want to see the market profile expanded, right? So you can see each period, you know, separately, whatever, then you can hit expanded and it's the same thing. The default colors, I forget what they are. I don't personally love them, but you can change the default colors right here. And I find that it's easier to just use, you know, Roji Viv, the rainbow pattern, right? And also you can do certain things in here, like, let's see, like emphasize, oops, I thought I did that. Like emphasize the first digit, which would just highlight, it would have bold the first new period, right? So I'm going to just leave that on. So yeah, that's what that is for TOS. All right. Okay, let's see. Could you recommend some good resources about this POC thing, please? Okay, so I mean, to be completely honest, the understanding of the POC itself, that's pretty much it. You got it already. It's where the most volume and or time was traded, and so that's going to be the point of control. Now, regarding like more material regarding like how you want to analyze with it or whatever, of course, anything that Dalton has wrote, Jim Dalton, anything he's wrote is superb. I really think he will be a legend in trading in the future, decades from now. You know, I think he will eventually rise to the status of like, you know, like Dow or Wyckoff or you know, any of these major players. What's the other guy? I forget. You know, those major traders, Schwab even, right? Those big traders from back in the day, Laffer. Yeah, write the name. Yeah, sure. Albert, I would just, I will slide into your DMs. No worries, sir. Hold on a second here. Let me just write an alert to myself. Thanks to Albert. In 30 minutes. You are so welcome. But I'll write it down for you as well if you want to do a Google search. His name is James Dalton. The book that I recommend for a first-time reader is Markets in Profile. I think that's the one at least. Let me double check. That that's the right one. Yes, that is the correct one. All right. How do you set up a watch list to stalk trades like this? Okay, so how you set up the watch list is, by the way, Rick, let me know if you want me to answer that POC question regarding BA. I haven't checked in on it yet. How do you set up? Okay, so the way that I stalk, I guess, is I use that same exact term, so that's why I use it. You can see it right here. This is my stalking watch list, and I typically will organize it based on what kind of play it is that I'm looking for. Now, obviously, section 3 is, you know, is all, and section 2 is all a jumbled mess, because those are all in there for a reason. You know, somebody asked me about it or whatever. So I'm just keeping tabs on it. And that, honestly, this is where I populate all the swing trade posts, right? All the swing trade posts, you know, they come from this list. I just scroll through it literally every single day. So I don't really construct a watch list to look for this style of trade. Rather, I construct my watch list in a fashion that reminds me what kind of play I'm looking for. And by play, I don't mean the trade entry tactic. No, I mean, what am I looking to develop as for the trade to be confirmed. So for example, here, ATVI, I know that I'm looking for a monthly higher low on ATVI. No, I'm not. I'm wrong, actually. So I need to change that. Technically, we have lost the monthly higher low pattern. So honestly, this should be probably a quarterly higher low. Yes, we'd be looking for a quarterly higher low. So for play, yes, for play, you see how I'm looking for a monthly higher low. So I know right away what I'm looking for if I'm looking at play. So now how am I going to position for this? It's no different than Bitcoin. Bitcoin, we were looking for a monthly higher low as well. So whenever we develop a daily sideways range, I'll start bottom fishing the low ends of that range on play to look for a potential monthly higher low. And honestly, I should have been doing it already and I failed. You see, because I didn't do my homework. So you see how there was already this sideways range to be playing with, just like all those other examples that we discussed. So honestly, to be completely honest, I probably put on a position today. I'll probably put on a low risk position today, looking for that monthly higher low to be potentially set. Let me see here. Yeah, I'll probably start scouting this right now. Honestly, as soon as this call is over and I send Albert that material, then I'll probably look for this right away, and I will just be looking for a monthly lower high, right? But that's my process. I don't organize it based on the trade setup, right? I know which setups I like to run the best, right? If I have to choose, it's going to be responsive trade, okay? Then it's going to be like a higher low that is also has confluence with price action and has the key time frame below extended, right? It's my second ideal trade. Or the third scenario is going to be a contingency plan for my responsive trade. That's really it. I look above and fail, or look below and fail. These are my top 3 trades that I know I'm going to use one of these 3 methods to enter any of these trades, regardless of what it is I'm looking for. If it's a daily range play, if it's a monthly higher low, like this is yearly breakouts, right? So you see, I organize the list in this fashion so that you can know what to start doing, how to anticipate, like what your expectations should be, what your anticipation should be. If I'm looking at a yearly breakout, it's a very different play than if I'm looking at a daily range play, right? So for JCI, right, we posted about this way back when, I forget when. I'm really happy to see that it's played out well, because I want to work these longer term trades into my rotation, because it's just better for my account standing right now and my bandwidth. So this is a huge ascending triangle breakout, right? So right away, I know I'm looking for like, a few years of continuation. And so am I going to be really worried if the weekly starts pulling back aggressively towards these prior highs? If we don't violate, here's that last high over here, at all-time high, right? Roughly. All right. So now in the back of my mind, I know I'm playing for a yearly breakout. So am I going to sweat scaling down? If we retrace 16%, I'm not. In fact, I will be looking for an opportunity because I've already positioned. I'm scaling out of this trade, knowing that it's a yearly breakout play. I want to take off some of my position on this initial thrust, knowing that this play is going to make, if it works out well, it's going to make many weekly and monthly higher lows and higher highs, right? So my expectations right away are changed. Right away, I'm not terribly worried about consolidation. If this was I'm looking for a regular weekly higher low in a name that's not breaking out of a huge yearly pattern, okay, that's a little troublesome. I'm worried about that. You see, so the what you're anticipating out of the price action development is really how you want to organize your watch list. Okay, it's going to help you to compartmentalize your approaches. It's a lot easier because think about it, right? Every single time you trade, you have to know what your trade is going to be, right? Your entries, exits, whatever. And so that's already difficult enough. And how do you plan those things? It's by understanding what you expect to occur, right? So you want to organize your watch list by what you expect to occur. And then you could obviously, because you know what you expect to occur, it's a lot easier to choose which tactic to employ in order to try to capture that move. All right. On Friday, you said FEYE was a broken chart. Did I say that? Oh man, I don't know. Let's see. On Friday, I said it was a broken chart. Oh, I don't know if did I say broken chart? It's not broken, right? Obviously, it's doing the job, right? It is showing me time and volume and price. So if I said it's broken, I apologize. That I spoke inappropriately. It said it was ugly and I hate it. That sounds more like me. Yes, yes, it's ugly and I hate it. That's totally fine. I don't think it's broken though. I support your best life, FEYE. I know you're doing your best out there, but I hate you and you're ugly. And the reason why is because it's just choppy. The thing has just been choppy. It's entire inception, right? And so the only trade that I like on a chart that's completely choppy its whole time is really just bottom fishing the lows. This is what I was talking about before, right? Where you have a low, look at this huge trading range, and then we tear below it. So what's the market trying to do here? It's trying to resolve this balance to the downside. How well does it do that? It doesn't do that well at all. If we come back into this trade here with our stop below that low, I know it's a lot of range, but that is a totally appropriate trade in my opinion. If the RR is suitable for it, I don't think it is here. Let's see. For using this low, I don't think it's appropriate. It is. Okay, so even if you were okay with 30% risk, which obviously, I don't know of anybody who would be. Is it full of gaps? No, it's not really full of gaps, my friend. No, it's just, look, this is chop, right? Check it out. We have a low, we have a lower high, we have a higher low, we have a lower high, we have a lower low, no follow through. We have a lower high, we have a lower low, no follow through. We have a higher high, no follow through. We have a lower low, no follow through. We have a higher high, no follow through. This is chop. This is the definition of chop. So when you ask about, if you ask me about a chart that is just on Friday, so we were here, what, this is the middle of the range, right? Practically, this is the middle third, or at least, of the range, right? And so, do I see clear trade here? I do not, because the most clear trade for me is balance, right? Side to side. That's what I want to see. Markets, again, spend a lot of time balancing, right? So that's what I would consider a much nicer chart. A much nicer chart has a lot of price action, that has a lot of this, that has a lot of chop, it has a lot of trend, it has a lot of chop, it has a lot of trend. If its entire existence, for the most part, has been chopped, I would say that's pretty ugly chart. It doesn't mean you can't play it. Definitely take these plays. I have, I would feel totally fine taking plays down here in the 1050 level. Okay. Even broken charts deserve trades. Is there more clarity in the weekly? There is more clarity, but even this, I wouldn't consider terribly clear, right? It's just very, very choppy. Let's see the 3-month time frame. The 3-month is probably where the clarity starts to begin for me. Okay, so we have a clear trend here. This is very clear for me. No follow through. Now we're ripping up. We're looking for that monthly higher low. I mean, that quarterly higher low. That's what we're looking for. So if we start chopping around, and I wouldn't be surprised, Rick, mark my words, right? We'll upload this episode. Come check back in it. I wouldn't be surprised if we find some support at 1420. This is a lot of chop here, right? Marked. All right, marked, right? I wouldn't be surprised if we were to come test this level. I wouldn't be surprised. If we're looking for that quarterly low, I bet you we get some preliminary bounce here. I bet you. And especially if the monthly can get extended, which it probably won't be, but let's say the weekly were to get extended, it would be. I bet you you'll get a decent shot there. And the low ends of this value area also a good. Let's see. Let me mark it up. Yeah, I would be interested in plays like this. This would be a more aggressive play, but off the POC and into this value area, where the blue becomes gray, that's the value, right? Where 70% of the volume has been traded. So I would be comfortable with something like this. I would probably try to include a fill under this major low right here. Okay, let me zoom in a bit. All right, so something like this I think is very reasonable. Totes reasonable. IMO. All right. I think I skipped something here. Let's see. Looking for a daily higher low, look for hourly oversold, or 4-hour, looking for 4-hour higher low, look at extreme 1-hour. Is that correct? Yes, if you're talking about a 24-hour market, then the key time frame for the daily time frame is the 4-hour, not the hourly. We use the hourly on the daily time frame for securities because a regular trading hour is 6.5 hours, right? So we want roughly something similar, right? Why? Because think about it, it's the composition of the candles, right? It's the composition of the candles that matter, right? Because think about it, if we're in one period, right, and we want to make a trend, you need, oops. Why is it not being straight? I don't know why it's doing that. Either way, Yeah, let's just say that this is the candle. Okay, it's not going to be a straight candle for whatever reason. Oops. All right, so let's say this is the time period, right? And we want to see a trend change. What do we need to see, right? We need to see a bounce large enough to anticipate a higher low, right? So probably at least 3 candles of bounce or so. Then we need to pull back. So at least 1 or 2 candles of pullback. Then we need to break to higher highs, right? So how many candles is that? Right? 1, 2, 3, 4, 5, 6, 7. So if this occurs on the hourly time frame and each daily candle is only 6.5 hours, then we can pretty safely assume, although it's not a guarantee, that that daily pivot has been set, because it literally takes that many hourly candles just to print 1 daily candle. So if it spends the entire 6 hours doing that, think about what it would need to do to reverse that. Another 6 candles right after, right? What are the odds of that? It happens, but what are the odds of that happening? Not as good. You see what I'm saying? So yeah, if we're looking for a 4-hour higher low at extreme, I typically will use the 15-minute for the 4-hour, although that's again with securities. So I don't honestly very often trade the 4-hour. I'll be completely honest with you. I don't. But if you were to use the same metric, I think the 30-minute would probably be closer. That would be 8, right? 1 to 8 would probably be closer. Okay. Today we bounced from open with no hourly consolidation, no problem, Roth. Good entry for short. I have no idea what you're talking about. Rick, I don't know which ticker you are talking about. FEYE, okay. We bounced from open with no hourly consolidation. Good entry for short. Yeah, you could do it. I feel like just ignore everything I just said regarding this ticker, right? So remember, where do we have the most confidence in this in trading? Don't force it. You know, you don't pick the ticker and then trade it. Don't pick the ticker and say, okay, well, I'm going to trade this ticker. You know, no, it's a yeah, let's go. You trade a thing because you trade a ticker because that ticker is presenting you with an opportunity that you can trade. Right. So if you have to ask somebody, you know, is this a good place? Right. You probably don't want to take that trade. You want to take the most high conviction trades that you have. Right. This is doing what I've seen it do so many times before in the same context that I know is best. Right. That's the trade. That's when you trade it. You know, so is it a good place for a short? It's not bad. You know, I can see how it could be a good place for a short, but you see how this is a binary question as well. Right. I don't know enough. Right? What kind of a trader are you? What's your risk tolerance like? What time frame do you operate in? How much time do you have? You see what I'm saying? You don't want to ask binary questions. Binary questions will get you nowhere. They will get you. There's nothing binary in this market. There's no certainty in this market. Think it's all uncertainty. You're thinking, you got to think from potential bets. You know, you got to think from a perspective of bets, right? When you bet, you don't know. You never know. There's no such thing as a sure bet, right? You see what I'm saying? You know, so if you are looking short and you are like defending the gap fill, like let's say your thesis is that, okay, well, I think these highs are going to hold, you know, I don't think they're going to get any gap fill. Fine. You know, if that's your thesis, great. If that's your thesis, this is a good place for that short. And now you want to monitor for continuation. You see, so whether or not it's a good place for a short matters very little in the general sense. First of all, you don't even know, right? You never know without enough context, right? So it's a matter of, is this a good short and can I trade it, right? You see what I'm saying? So
I should have been more clear in my question. The reason I asked is because Dan typically, he says, okay, this is bounce with no hourly consolidation. So we don't have confidence in it because there's no trend change. And I'm looking at the bigger time scale, daily, weekly, it's in a downtrend. So I was thinking of entering a swing short.
This is a terrible place for a swing short, in my opinion. Because again, remember what I just said, right? We're in the middle of this huge range. Look what happens in the middle of this range. We just go chop, 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 right? So I personally do not think that. And again, I encourage you to think about what you literally just did. Okay, I encourage you. This is the lack of confidence in bulls does not mean confidence in bears. That is not the same thing, right? So if Dan says we don't have confidence in this bulls, doesn't mean bears are going to come and just roll over this guy, right? But you just saw it in BA. You literally just saw this in BA, right? Think about it. Like, look at what just happened, right? So we have this high confidence, we have this low confidence and bullish continuation, right? Because we know that we have ripped up to this POC, right? We've ripped up to where these two POCs are stacked, I should say, right? These two POCs. We know we ripped up to it. And what happens at that moment, right? We're testing it at that moment. Boom. Does that mean we can be terribly confident in bears? No, because what did I say in that thread? I don't like one time framing, right? When you one time frame up, what does that suggest? That suggests that there's a lot of underlying strength. So very often when you try to go short, you try to fade a move that is all one time framing up, it usually gives you nothing. It usually gives you nothing back. And that's why I said, hope you got yours, make sure to protect. And that was the freaking low. That was the low of that move, you know? So it's not about knowing, it's not about predicting, none of that. It's about being as safe as possible. It's about increasing the probabilities, right? We want to take high probability trade location. And even when we take high probability trade location, we want to pay ourselves so that we can be protected should the low probability situation occur. Right? You see what I'm saying? Just like PFE. This is actually freaking perfect, eh? This is just like PFE. We're protecting ourselves against the potential of this going down. Doesn't mean we just look short, right? Doesn't mean, okay, all right, for sure, we're going to exit our trade completely, get out of this thing. This thing's going to hell. No, right? We just don't have as much confidence here. So we ask ourselves, what should we do when we have less confidence? Should we reduce risk? Should we keep risk the same? Should we increase risk? We should reduce risk. You see what I'm saying? And then come back in when our confidence can be higher, even if it's higher up. I don't even care. I will very happily play higher. I'll very happily buy my position back higher if that new setup and that new context is appropriate for it, if it plays into my strengths. Make sense?
Okay. Yes.
Okay, cool. I believe we are out of time. So I think that's a fairly good place to call it. And that FEYE stuff, mark my words, my friend. Mark my words.
That's marked. Okay.
Yeah, we hypermarked it, highlighted it, 4 different colors.
I'm gonna upload this one.
All right, thanks so much. Thanks, guys.
All right, no problem. Great questions. Have a good one, y'all.
Thank you.